Hi, all. I'm Cullen Haynes, and welcome to Lawyer Lending Live. My next guest is a numbers man through and through. Previously worked for 10 years at a large bank, but over 20 years in the business of property investing, and all word of mouth, no advertising whatsoever. Founding member of PIPA, Property Investment Professionals Australia, and currently the managing director and founder of Essential Property Group. Could you please make very welcome Peter Ward? How are you, Peter?
Well, thank you, Cullen. And you?
All the better for hearing your dulcet tones and seeing your smiling face, sir. And our viewers and network are in for a real treat today.
Yeah, I thought we might take them through some of the things that property investors don't know that they don't know.
I think that's fantastic because, you go to the barbecue on the weekend and Uncle Bob's there, and Uncle Bob, who's never bought an investment property in his life, will tell you everything you need to know about your investment property. And everyone trusts Uncle Bob. But I always say, never take advice on the journey from someone who hasn't left home. And would you agree?
I would certainly agree. It surprises me the number of Australians that will take advice. I had a guy once even who took advice from someone he met at the pub at one of the casinos in Melbourne.
Oh, good. Yes. So that, salt of the earth, as it were. But nonetheless, we're going to do things a little bit differently today because, when we chatted, you are quite analytical in your approach when it comes to property investing. And I think some of my legal clients and wider network would appreciate the way you do things as opposed to many in the industry do in like an industry crowded with maybe not nefarious types, but those that don't have a critical eye that you do. But so welcome you to share your screen and go through what you want to chat about for the next 20, 25 minutes, my friend.
Sure thing. Well, thank you, Colin.
My pleasure.
I'm just going to take you through a few of the slides that I use with clients in what I call Wealth Skill Stage 1. It's stage 1 of a 4-stage process for clients where they're learning and we're assessing and that sort of thing through stages 1, 2, and 3. And it's not until stage 4 we actually start even thinking about property. Just so that you're clear on it as well, I don't charge clients anything for stages 1, 2, and 3. There's about 6 hours working there with them to prepare them. So we'll get onto the slides. I'll take you through some of that stuff. I'll show you some of the key elements of getting it right in property, some of the live research and so on, and we can see how we travel from there. So absolutely. So just while you're doing that and getting your screen shared, Peter, I will invite people. It is 12:34 in Sydney, Australian Eastern Standard Time. So be sure to put your questions in. It's live. We're broadcasting live, people. YouTube, Facebook, LinkedIn, of course. So we're honored to see it. But I've got your slides here. Let's go through it, my friend. Let's do it. Stage 1, wealth skills. We'll get stuck into it. Yep, wealth skills stage 1. Quite a bit of learning goes on in here, and I don't have anywhere near the necessary amount of time to go through all of it. It's quite a lengthy process with clients, but this is designed to just give people a bit of an indication of what I call the 6 essential elements. And I'm going to just pick a couple of the key elements out of that group. And this is all about getting a balance between capital growth on the one side and cash flow on the other, and what strategies we can adopt in each of those columns that will stack the odds in the favour of an investor receiving consistent, reliable capital growth and consistent, reliable cash flow over the long term. One of the most important elements of this, and one that I get surprised by, I suppose I shouldn't after 20 years, but the number of people who just aren't aware, should I say, of the fundamental importance of having land as the primary asset, because I'm sure most of the audience will realise that it's land that goes up in value, not buildings. Buildings go down in value. And of course, as a consequence, the more we spend on the building, the less of our assets actually doing any work. So this live example I've got here is a residential street in suburban Melbourne, live data, straight out of RP data. And it gives us a pretty clear insight of just how important that land component is. So you can see there, we've got one highlighted with a green line around it. And we're going to compare that. You can see there's a red roof there. That's the primary house. The rest of it has been tacked on afterwards. So it doesn't actually comprise part of the residence. But we're going to compare that with, say, one of these big ones down the other end of the same street and have a look at what sort of results have occurred on those properties over the last 40 odd years. So here you can see on the left, we've got a not tiny house, it's still 4-bed, but it's smallish at 164 compared to a 400 square, which is a fairly big house. On the left, and the right, you can see the land is about the same size in both cases in this street. There's the purchase prices for them in the late 70s in this estate. Okay, so back in the 70s, one went for nearly half the cost of the other, but of course one's got a very big house on it. And there's the results 40 odd years later in terms of what the properties are worth. Now, I'm sure you can see there's not a huge difference in value between the two, considering the difference that was invested to begin with. And a more important question I tend to ask here is, imagine for a minute, back in the late 70s, you had $120,000 to invest, and that's certainly possible back then. Consider what you could do with that same 120,000 back in 1977. Clearly, you'd be able to take two properties on the left or one on the right for the same expended dollar. And if we extrapolate that out over 40 years, it's an entirely different outcome. The reason this is so important is because the guy on the left with the smaller house has spent around 70% of his invested dollar in the land, and the other 30% he spent in the building. And of course, he had 70% of his asset going up in value. But on the right, we've got the guy who spent 70% on his house and only 30% on the land, which means he's got 70% in the building going down in value. And you can see here over 40 years, that has an incredibly important impact on the value of the asset. And it's one of the reasons that many investors make mistakes when they're investing, because they're looking particularly to invest in units, for instance, which are only about 10% land content. That's even worse. Yes. Here we can see the impact just between two houses. I haven't even talked about units. So the key here is, and the main point to get here is, it's the piece of land that's the important asset. And we've got to be careful about the building that we actually put on that land. And when we get that mix right, then we're maximising our capital growth capability. The next one I'd like to talk through is what I call the jewel in the crown of WellSkills Stage 1. It's the timing and how to get that right. Because most investors are unaware that it's possible to actually determine, see this white line here, if that's a growth curve, buying any time in that green patch there is fine. There's no issue with that. We don't want to be out here, it's too late. Unfortunately, that's where about 70% of investors buy in that last 20%. Yes. But the ideal would be to figure out where this red star is. And nearly everyone I've ever met is of the view that that's a bit of crystal ball gazing. But what I'm going to do is actually physically draw live for you now the diagram that I do for this with clients, so you can see that it's not actually guesswork at all. So you should be able to see a curved line on there in a graph. Yes. That's good. Okay, so this curved line here is the Sydney property cycle going back to the early 80s and through to now. In 1989, the median house price in Sydney was around 200,000. In 96, 7 years later, it was 200,000. But by 2002, it had gone up to 496. By the middle of 05, it had dropped to 465. 2017, it went up to 1.02 million. Then it dropped down a bit to 982,000, and now it's sitting at about 1.4 million. So we can see from that what Sydney's median house price has done over the last 40 odd years. The question, of course, that comes to mind straight off is why, after this great growth period here in the early 80s, did the market suddenly turn like that and go dead? Now, I've been asking that same question for 20 years, and I tend to get three consistent answers. Firstly, there is, here in about 1987, it was, I think, was a worldwide stock market crash. Really significant influence economically. A very common one that I get is home loan interest rates, which at the time, and I was a banker back then trying to do home loans, which were at 17%. I think they've got problems today. That was a dreadful time. And that was brought about by the third item that most people comment on here, and that is right here in 89, 90, 91, we had what was called the recession we had to have in Australia. That's what actually caused the 17% home loan interest rates. And they're the three standard answers I've received for the last 20 years about why this market in Sydney died in 1989 like that. But I'd like you to consider with me an important element around that. And that is that here in 2002, exactly the same thing happened in the market. It died in 2002. Got to 496 and was arrested there. But we had entirely the opposite set of economic conditions there. We had amongst the lowest interest rates in 60 years there. We also had no recession we had to have. In fact, the financial position of the economy generally was amongst the best in the developed world at the time. And there certainly was no stock market crash. So here in 2002, the economic conditions were exactly the opposite to what they were in 1989. That tells us that these items, the recession we had to have, the stock market crash, the interest rates, at best are contributing factors. They are not cause. Because if they and things like them were the cause, then here in 2002, the market should have just kept going because the economic conditions were near perfect. And
absolutely. And Peter, on that live map, are you able to show us the live dates across? Because I think the graph that people are seeing right now is the 1 to 10 years property timing cycle. I don't know if you have a separate one that shows the years.
Okay. I'm sorry. Yes, I hadn't realised.
That's all right. If you could show, like, I'll unstream the thing and then share it again, because I think everything you're saying, if people could visually see it, it would really make an impact for sure.
Yeah, I'm sorry. I thought it was already there.
There you go.
Now.
Okay.
There
we go.
Yes.
So, guys, so everyone watching, this is everything that Peter has been talking about in terms of the cycle. So, if you want to, we got a lot of people that have just joined in there, Peter. In a nutshell, just in like a 1 minute, explain this. What's been happening here?
What's here so far? Yeah. Okay. So what we see here is the Sydney property market going back around 40 years, and the median house prices and how it's going in waves like this. And every so often it goes down, and then it goes up, and then it goes down, and then back up again. And I was asking why it is that in 1989, the median house price, because there's great growth here in the early 80s, but why it stopped here in 1989. And the usual reasons are the recession we had to have, the high interest rates and things like that. But none of those existed here, but the market still stopped. Sorry, none of them existed here. Can you see my cursor there?
I can.
Yeah. Okay. So here we had the recession we had to have, and people tend to think that's why the market died there. But here, it still died. But the economic conditions here are exactly the opposite to what they were in 1989. And as a consequence, we need to be able to understand why these fall-offs happen, even when economic conditions are good. And it tells us that there are cycles that are going on here. Now, understanding how those cycles work comes down to understanding a very simple law that I'm sure everybody has heard of, and that's the law of supply and demand.
Yes.
Everybody's heard of it, but understanding how it works here in the property market is where the blind spot is. So I'll take you quickly through how I assess this, and that is, we'll start with what I used to call the 30-30-30 rule. That's back when I was a banker. They call it DSR these days, and I'm sure you're familiar with that, debt service ratio.
Of course.
But the 30-30-30 rule was based on gross incomes, not net incomes like the DSR. And this is where we start to see a breakup. So an average family can afford to spend approximately 1/3 of their gross wage on home loan repayment or rent, somewhere to live. Another third gets spent on all the other living costs. And of course, the tax man's got to take his cut. So this is how it gets broken up. Yes, of course. It's this top one that's important for us, because that's up to about 36% of gross household wage is the upper limit of affordability for an average income earner. And in 1989, we go back and have a look, but when the median house price reached 200,000, the average income earner in Greater Capital Sydney had to contribute around 42% of gross household wage to buy in.
Yes.
Now, 36% is the upper lending limit, and it costs 42 to get in. You can see here we have a serious problem with a fundamental lack of affordability. Now, I'm working here with the Yeah, I'm working here with the average income for the greater capital region. I'm not interested in the very poor or the very rich here. The average, which is in the middle of the bell curve, if they had to contribute 42% of gross household wage, affordability is gone. And as a consequence, we cannot have demand. Okay, so the bulk of the population demand drops right off. So half of the supply and demand equation is out of balance now, because I'm sure viewers will know already that the supply and demand equation is fairly simple to understand. If you've got low supply of something and high affordability or high demand for it, then prices are going to go up. If you've got a high supply of something and poor demand, price is going to go down. So the two conditions we want for price growth are low supply and high demand.
Yes.
So here we've got poor demand because of poor affordability. But what's going on with supply? Well, during this period here in the early 80s, builders and developers are making hay while the sun shines, because there's a lot of growth going on. Our 36% colour, that's right, yeah. Our 36% colour point of affordability is right about here somewhere. Okay. And people stop buying after that. Builders and developers keep building because they don't know any better for whatever reason, but people stop buying right about here. Now, if people have stopped buying, but builders and developers are still developing, then we finish up here with a huge oversupply. So now we have too much supply and not enough demand. And in that environment, price can only go one way, and that is down.
Makes sense.
So, yeah, the question here is there any easy way of telling when that is? And there is one, and I'm going to show it to you in a moment, but there are other measures that you can look at yourself as well out there. And that is, for instance, what's going on with the vacancy rates. Because at this point,
what's happening with the vacancy rates, Peter? Tell us.
Oh, well, vacancy rates at this time in Sydney were between 4 and 7%. They're around 7% for the most of it. That's pretty poor vacancy rates. That means there's a lot of property lying around with nobody in it. And that means that there's too much supply for the demand that was going on, but also yields. So this is the rents. Rents in Sydney at that time were 1 to 2%. Now, the reason for that is simple, because this 36% cut-off point of affordability here also applies to tenants. They can only afford 36% of gross. So if you're buying in price bracket up around the 200 there, but they can only pay down around here somewhere, then there's a gap between what they can pay and what you actually would like as yield. And as a consequence, your yield goes down. So 1 to 2% yield was common. And both of these are easily accessible as you move forward with time. Now, 6 years goes past, and two key elements change that bring the supply and demand equation back into balance. Firstly, let's talk about the affordability. This 42% of gross. 36 is the upper limit. 38, things are starting to get a bit tight. 39 and 40, you start to hear market talk about mortgage stress. I'm sure people have heard that term. Getting up into 41, 42, 43% of gross household wage, we're getting into the territory of extreme mortgage stress. So here at 42%, we're getting up toward extreme mortgage stress, and that's causing all sorts of problems. You can hear that going on in Sydney right now, and it has been for several years. People can't afford to live there, and they've been complaining about it. And of course, at this point in the market, they can't afford to buy. We start to see industrial action happening and that sort of thing. Quite often in the public service first. So we're talking about teachers, fireys, nurses, police, and so on. And because they've got such large unions behind them, there's a lot of pressure on the state government to do something about wages. Now, of course, you never hear a state government come along and say, yeah, sure, we'll give you a 10% pay rise tomorrow. Doesn't happen. But you can ask for it. That's what you might have heard the term ambit claim. But at the end of the day, wages pressure does occur. And the rate that it increases varies from time to time. But bear with me on this one, Cullen. If wages are going up...
I will bear with you.
But the median house price is not changing. So let's say the loan repayment is remaining the same. If wages are going up, but the loan repayment's not changing, that 42% of gross household wage commitment is coming down as a percentage because the wage is going up. The lowest I've ever seen it in Australia, one of the Australian capitals, is 21.3% of gross household wage to buy into the median house price. That was in Perth about 4 years back.
Okay.
So you can see here then at 21.3, we've got affordability back again, which means we can have demand back because that's the bulk of the population, the working population in the greater capital. What about supply? Well, right about here somewhere, builders and developers stop building and developing. They do finally get a handle on it because they've got too much stock laying around, so they stop. And over the next 4 or 5 years or so, there's very little development going on because there's huge supply to be taken up. So there's no construction going on, but wages recovery is happening, affordability is improving, and there's population growth going on in the state. And as a consequence, the supply slowly diminishes. And we get back to this point, and there's a shortage of supply now and strong demand because of strong affordability. Price can only go one way in that environment, and off it goes again. What does that look like in these other variables? Vacancy rates during this growth curve here are typically between 1 and about 3.5%. Yields, I've never seen it less than 4%, rarely see it over 6%. So you can see it's basically the exact opposite to what it was back in '89 there. You flip reverse them, and that's the result. So the answer to the question, is it possible to figure out the timing of all of this, is yes. And the way I do that, if I change colours here, is I start with the median house price and the median wage. Because with those two pieces of information, I can calculate that number. And if that number is sitting at 22% of gross household wage, it'll be somewhere here in its growth cycle. If it's sitting at 34, 35, 38%, it'll be somewhere here on that market and anywhere else along the continuum based on what that percentage commitment is. And remember, this is the bulk of the population in the bell curve, not the fringes. And that's why that element is so important, because it relates to the bulk of the population. So that's how I figured out the growth cycles for each of the capitals for the last 20 years, and figured out when they were happening before they were even showing up in the media, for instance. It's just about understanding.
Let me ask you this, Peter. Has anyone else figured out this framework similar to yourself, or do you find that your research is quite different to the mainstream media and what's been purported?
Look, to be honest, Colin, I haven't seen anybody else teaching this. I don't know. I can't say for certain nationally that nobody is. But of all the people that I've encountered, and I would have met probably 600 brokers in the last 20 years, and accountants, financial planners, and of course a lot of clients, none of them have ever seen this before. In fact, I had an accountant come to me in one of the first workshops I did in Newcastle about 20 years ago. And he's got a fairly extensive business here in Newcastle. And he came up to me after I'd presented to this particular broker's team of clients. And he said to me, you know, I've been advising clients for 40 years about property investment and other investment types. And he said, from what you've shown me there today and the timing, I've been misadvising them because I didn't know how that worked. And that was an accountant. Pretty uncommon for one to be so straight with me about that, but he was impressed by it. And the key here is, it's not something that I've designed. Supply and demand equation is something that everybody knows about. They just don't know how it works in property. And it's obviously my banking background gave me a bit of an edge there in figuring out how to look at some of that information. But the information is out there. We've just got to know how to put it together and look at it and understand it. Now, one of the other obvious things here is that's just the Sydney market. If you came to me here in 2002 and said you wanted to buy a property in Sydney, clearly that's not a good plan. It's about to go down 30 grand. But I discovered through the research that around 12 to 18 months after Sydney does that, Melbourne does a similar thing. Around 2 to 3 years, not always the same amount, after Melbourne does that, Brisbane and Perth do exactly the same thing. You see, there's this this fable, I think you could call it, in Australia, that there is an Australian property cycle. And when you hear the media talking about it, ABC and all the others, they talk about the property market is in trouble, or it's on a high, or whatever else. They talk about it like it's a national phenomenon, and it's not. And clearly, if you go back and look at the data,
you heard it here first.
Yes. We do have research data on this going back to 1970. So there's about 50 years of data available that demonstrates this very point. And if you look at these lines, you can see there's a staggered growth cycles going on. Each of the capitals has a significant economy of its own, and they are operating independent of the national economy, influenced by it, of course, but each one is operating at different times in the way that it works for property. And that's useful because I can say to a client, let's buy a property here in Sydney and hold it for a couple of years, 2 or 3 years, waiting for it to accumulate equity. If we do that, we get to here and it's worth, I don't know, say 300,000 at that point because it's going up to 500. Well, there's 100,000 equity there now we didn't have before. So we can borrow a deposit against the equity on it and just buy another one in a market that's heading into growth and hold it until it develops the equity, borrow a deposit against the equity and buy another one in a market that's heading into growth. You see, at any given time in the Australian economy, one of these 4 major markets is either in growth or about to go into growth. It's just a matter of knowing which one, and that's just a matter of doing the research.
See, which is what you're doing.
Yeah, that's it. Now, I won't go into too much more detail here because there's more detail to go into, but I know we're pressed for time. So you'll notice there's only 4 capitals on there, for instance, not 7. That's because I don't put clients into any of the other capitals. And the reason for that, I don't have time to explain today, but happy to help and share with anyone who wants to learn it. Also, you'll notice Newcastle's not on there. Now, Newcastle's my hometown, and it's the largest regional economy in Australia. And I will draw this one because it's quite an important element that most investors don't stop to think about. And that is, why is Newcastle as a regional not on here? I don't put clients into regional markets at all. And the reason for that is because back during this period, and don't hold me to the exact years, but Newcastle did this, where it went from beginning of end of cycle to end of cycle there, 12 years. And then within the next 3 years, it doubled. So that's a 15-year cycle there. Now, if I stop sharing and reshare to go back to the slides, because that's what I've got to do, I think.
Yes.
Okay, you got that back up? I'm not seeing it, but as long as you can see it, that's fine. If we take a look here at Sydney's median house price going back to the 70s, you can see a pattern where the median house price is either doubling or tripling every 10 years. And if we look at the rest of the capitals, we're seeing exactly the same thing. It's like clockwork, either double or triple every 10 years or so. And my question is, if the major capitals have a track record of doubling every 10 or 12 or so years, why would you want to do a 15-year possible cycle in a place like Newcastle? And the answer is no. It's not a good plan. Why did that happen in Newcastle? Why would we have 12 years of no growth? The answer to that is why I don't put clients into regional markets. And that's because right back at the beginning of that, the BHP packed up out of Newcastle and left Australia. And Newcastle was built around the BHP, and you can imagine the impact that place closing had on the local economy. So it's the classic mining town argument, if you like. Okay, once the mine's gone, you can forget about property being any good for you. And this is the basic principle I teach about this, that regional markets, all of them, their local economies are built on one primary industry or another. And if that industry gets into trouble, your investment assets do as well. This is why capitals are a better long-term strategy in my view, because the risk is much lower. They have got critical mass, if you like, of industry and commerce. So if any one company packed up and left, there's something else, there's plenty of others to take up the slack. That all makes sense?
Of course. It does. I'm sure some of my legal clients and lawyers in Newcastle may be at odds with what you're saying there, Peter, but I'm sure you welcome the challenge in thought.
Absolutely. It doesn't mean, by the way, I don't have access to stock here or anywhere else in Australia. It's just that once people understand the importance of the timing and the dependence on one single industry, and in Newcastle, it's still dependent on one single industry for the most part here, which is coal. We've got the largest coal port in the world here, or one of them at least. And I'm sure everybody's well aware of what's going on with the climate change arguments and where coal is heading. So, you know, Newcastle Council have already identified they have an issue because at some point the coal mines here are all going to close, and there's not much else here after that to sustain such a large population. So we can certainly discuss that with others when and if they want to. There's the average annual increases across the 50 years for the capitals. There's the average for the big four, and for the rest, just for interest's sake. So that probably raises the question then, now that we know about the timing and how to understand it, where are each of the markets up to in that? So you can see here on the legend, red, any numbers in red, that's a real worry. Numbers in orange, that's a bit of a concern, and the numbers in green are pretty good, and that's what we want. So when I'm figuring out which market to be in for clients to invest, I need to see all the numbers in green. So let's have a quick look at where each of the capitals presently sit. So you can see here, affordability for an owner, presently the highest I've actually ever seen it in Australia. Remember I said 36% is the upper limit. This is dreadful. Yes. I imagine it will drop down a bit when the next and latest wage numbers come out, but it's certainly not going to drop down into the 30s. It'll be in the mid-40s. So this is a real worry, and you can see up here the median house price at the moment versus the maximum purchase price at 36% of gross for an average income there in Greater Sydney. You can see why there's such a problem there. Let's have a look at Melbourne. Okay, 41%, so that's not great either. The vacancy rate's good at 1.2. I'd like to see it under 3, and the population growth isn't too bad at 1%. But you can see here the median house price at 960, the maximum affordability is 843. So growth-wise, there's not much going to happen there for a while. Okay. If we now take a look at Perth, we see an entirely different picture. Take a look at the numbers down the bottom here. The lowest vacancy rate in Australia, strong population growth, and of course, here you've got the median at 632 and the upper limit at 824 at the moment on current interest rates. I expect to see interest rates go down probably by the end of the year, in which case that number will go up and there'll be a greater gap. But you can see Perth is all green at the moment because it's in its growth cycle at present. And if we look at Brisbane, Brisbane expired about October last year, as in growth cycle expired. And you can see there's very little growth capability left here either, and it's right up around the top edge. Vacancy rates are good, population growth is good, but the affordability is stretching its limit, and as a consequence, there's not a lot of room for growth in price there either. And so if we now have a look at the property clock, which shows the two phases, the non-growth phase and the growth phase, and you can see I've got them identified here around the edge, so we can see where the different phases kick in. And I've also got in the white there, the time to buy. So if we take a look now at each of the capitals and where they are on the property clock in terms of their phases. Okay, now for month in, month out, year in, year out, where all those numbers sit changes because each one is its own economy and the affordability and everything else is recovering at different rates. So I won't explain in more detail here, but notice I stopped putting clients into a market well before the growth finishes. Okay, I don't have time to explain why, but I'm stopping putting clients into that market at the time that most investors are actually jumping in because it's too late. All right, off that one onto the research. So when a client goes through stage 2 and 3, stages 2 are goals assessment and financial assessment and understanding some of the finer detail and getting the mechanics right between growth and cash flow. Stage 3 is where I present them with some kind of strategy to deal with what we discovered in stage 2 and their goals. And stage 4 is where the rubber hits the road. If they're still wanting to proceed and actually acquire a property, then we start to look at sourcing property that will meet the criteria for them. Okay. And to that end, the research documents are an important element of that. So for every area that a client's going to go and look at, they'll receive one of these research documents. They take me 2 or 3 days to complete for each one. And you can see this is a live one. I'm not going to spend any time on each page because there's not enough time, but it's to give you some idea of what's involved in the research. This is the jewel in the crown of the document. You can see here I take all of the, so like the supply and demand at the top here is first assessed at the state and postcode levels. If we get to 27 or 28 or better here, I'm happy to go on and then look at schools, shops, transport, employment, recreation, lifestyle, a whole bunch of other things that I haven't even covered today. And if we get to
there was one metric that you that really struck me last time. I think you did the amount of crime or socioeconomic index and education of the areas as well. I think that's an important score.
It is an important one, and I've yet to meet anybody that I've even heard of it, to be honest. It's called the CEFA score. You can see it down here in the middle of the page. CEFA index.
Yes.
This is the Australian Bureau of Statistics Socioeconomic Index Disadvantage Index for areas in Australia, and they measure it down to a street level, Colin. Very useful element, because I won't accept anything under about 960 on their numbers. Anything over that I'm happy with. But the reason this is so important is because the socioeconomic index measures things like non-English speaking background, poor education, single parent families, unemployment, all the rest of it, the socioeconomic demographics. And when you've got really low socioeconomic demographics, you're stacking the odds in your favour of a tenant either not being able to pay or not paying at all and doing damage to the property. They're far more likely to not be interested in looking after the property. So I like to see high CEFA numbers. That's part of the research. And the crime you mentioned, that's quite important as well, because tenants don't like to go into high crime areas, obviously if they've got families and kids. And I have found that not always, but quite often there's a correlation between crime rates and the CEFA index. The lower the CEFA index number is, the higher the crime rate is. This is one of those elements. Yeah, it's one of those elements. It's a blind spot for investors because they don't know what they don't know, and that this information is available and it's valuable to stack the odds in your favour of getting a reasonable tenant to look after the place. So that's a valuable document. The page, that one, it's easy to see with two properties alongside each other, what the strengths and weaknesses are. Then there are a whole bunch of other topics. I've dropped this actually in the middle. I'll finish the research document in a moment. I'm sorry, I put it in the wrong place. These are other subjects that I cover in the full property workshop: land versus house, what it's worth, the locations and what we're looking for. What's the finance all about? People need to understand the importance of guys like yourself who are skilled and experienced finance brokers. Most Australians don't recognise the value of that. Population growth. This is important for tenant supply, right? If you don't have population growth, well, there's not much going on in tenant supply. We need to look at that in a long term and a short term. This one is a correlation that exists between interstate migration and growth cycles. I won't go into detail, but there is a correlation, and you can actually graph it. Affordability for tenants. What's the price point we want? Most investors don't stop and think about that. And back to the research, you can see here, I'll skip through to some of this, the proximity myth for the CBD. I won't explain it, I don't have time, but it is a myth. And this research was done by Grattan a couple of years back to demonstrate that actually there's only about 10 or 11, 12% of the working population in the greater capital, they can work in the CBD. So trying to buy close to the CBD is actually counterproductive. This is all about the mapping for that. And, whoops, sorry, a bit too fast there. There's the CEFA number, 1026 for this particular area, very useful.
Which is good, right? 1026?
That's 1026 is very good, yes. 1152 is the highest in Australia. So anywhere between 960 and that is fine. This is past data, so this is demographic data for that particular area. And things like, for instance, vacancy rates. Property spruikers love to talk about what the vacancy rate is today, because in a growth market, it's almost very, very, very low. Some have even gotten down to zero. But that's invalid assessment in my view. I would rather take a look at what that area has done over a 5-year average and a 10-year average to see whether or not it sustains reasonably low vacancy rates. That's the kind of thing that needs to be investigated. Schools, 5 kilometre radius here. Where are the schools? What are they? Are they public, private, or both? And then you've got all this RP data. Okay, again, I don't have time to go through it all, but this is social housing or public housing. How much of it is in there? Median house prices, values, rents, yields, what they've done. This one is, remember I was talking about not buying into a market whose economy is based on one primary industry? Here's a good example of one right here. That's a live example where 25% of the employment there is tied up in one industry. That's no good. But this one is the one that's for this live area we're looking at. You can see it's good diversity across multiple sectors. Livability scores, comparable sales for properties of the same type that the client would be looking at. What about this one that's higher value homes? I don't have time to explain, but that's an important element. And then I go into looking at the government planning and scan through and have a look at all of the elements about government planning, what's in place, what's coming, so that we don't end up with some nasty surprises. Like, for instance, we get down here, Bushfire Attack Levy, BAL. It's not serious, but you need to know if it's going to apply. Same thing applies to, this is Perth Airport, for instance. Okay, you can see the approach vectors. Is there any noise impact on that? Then there's road and rail, that's that one there, and other key public facilities. And regional roads, infrastructure, what's going on with freight and rail. And in particular, I like to take a look at, for instance, transmission towers. So where are they now and which ones are proposed, so that we don't run into trouble there. That's the kind of stuff that happens in the research document. And just to finish off, the yield curve is what gives us some insights into interest rates. Now, I think I'm going to run out of time. We've got, what, 2 or 3 minutes left now. Was that right?
Right. We've got a little bit of time.
Okay. So the yield curve is an important measure around interest rates, and I'm sure people will be wondering about that. This is all about the 10-year bond rate and the 90-day bank bill. So you can see that blue line there is the yield curve. And it's the 10-year bond rate minus the 90-day bank bill rate. This is a measure that's been used for decades. And that 0.5% is an arbitrary number, but it's the one that they tend to use as a focal point. So if we take a look now at what the RBA's cash rate has done, because you can see here, oh, sorry, I forgot to mention, when the bond rate minus 90-day bank bill percentage drops below that line, the 0.5% line, then interest rates are likely to fall. When that goes above that line, interest rates are likely to rise. And that happens usually within a 3 to 6 month lag. So if we take a look at the RBA cash rate, you can see it's almost flipped, mirror reversed. And so let's have a look here in 2009, when the yield curve went above the 0.5 rate. You can see about 3 to 6 months later, interest rates started to go up because this had come up here. If we look at the other end, it drops down below the 0.5% line, so interest rates are going down, and of course 3 to 6 months later, interest rates have gone down. That has been reliable like that for quite some time. You can see it's going back to 91, and that's mirror reversed all the way. And it's a very important measure because it tells us where interest rates are presently heading. This one shows us where interest rates presently are. So you can see here in December 2022, the yield curve went below the 0.5% line. And as a consequence, somewhere in the 3 to 6 month period, now we've gone past that already, of course. But that, it's usually sometime in the first year or so that the interest rates start to go down. So it's been a reliable measure for 30 years. When the yield curve has gone down below the line, interest rates have gone down after it. It's just a matter of how long you've got to wait for that to happen. Don't have time to look at that one either, because that's just some of the results that clients have had in the last few years, with 47.8% median house price increase and that sort of thing in some of the areas. I won't bother leaving that there for too long. Suffice to say that there's a great deal more information available. We just don't have time to get through it all today.
It's been illuminating though, Peter. If there's one message that people could walk away with today, not putting you on the spot, but I am, what would that be? One message. One message is it's really useful to understand what it is that you don't know about property investing before you make any move at all. At least learn what you need to know, so then you're making some informed choices moving forward. And this Wealth Skills Stage 1 is about 3 hours of learning for clients. I don't charge anything for that time. It's an investment I make in people, but it provides them a foundation upon which they can build with informed choices moving forward. And I've got your contact details here, Peter, your mobile number here and your email address here. Where else are you hanging out? Do you welcome an invite on LinkedIn and a cheeky message?
Yes, I certainly do. If you've been listening today and you wanted to link on LinkedIn, I'm quite happy to do that.
Really appreciate that, Peter. And thank you so much for the wealth of knowledge you've shared. We'll break this into little bits over the course of the coming weeks and get it to the podcast when we upload the Lawyer Lending Live podcast episodes as well.
Sure thing. Sounds good. Really enjoyed it. Thank
Thanks,
you,
Peter.
Carl. And I hope everybody got some value out of it.
I bet they did, my friend. My lawyers have got a few questions already, I bet, especially the ones in Newcastle, but I'll let you know about that one offline.
Okay. Happy to answer any questions I can for anyone.
Thanks so much. And if you are a legend of lawyer lending and want to be on the show, come and reach out to me. We come out every Wednesday, chatting to a allied either lending or property professional. And we upload it to the Lawyer Lending Live podcast very soon as well. We're coming out with our Law Live later today with Emily Cubbins, who I will be interviewing, leading legend of law, and you don't want to miss that episode either. So hope all is well, everyone. Have a great Wednesday, and take care.